Hi, this is Kelley Wright at the Money Show in Dallas. With me, Mr. Neil George, Profitable Investing. You know, in my world, dividends are the straw that stirs our drink because it's real money.
It is, and the key thing about dividends is that when you're seeing steady, healthy dividends that are rising over time, it's a good indicator you've got a healthy company that respects its shareholders. And then also, even during some of the choppy markets, if you have the certainty of a portfolio that has dividends coming in, those regular checks, that buys patience. It gives you the stability to get you through a tough stretch in the market, and more likely you have good stocks that are paying those dividends that are going to make it through that same stretch.
A floor of safety, an indicator of future price growth. A lot of things dividends tell you.
Yes, indeed. And there's one company I'll throw out as an example that's been around in the market and is very shareholder focused. It's a company that was started by a friend of mine. He's no longer with us. Named Bill Carey, and he started a company called WP Carey.
Oh, absolutely, sure.
WP Carey, their offices in Rockefeller Center. They do the sale and leaseback properties around the U.S., around the world. So they do the triple net leases. So
right.
Effectively, the tenants pay all the bills.
Right.
And they reap the benefit of the cash flows. Very impressive portfolio, expanding, excellent cap rate. New properties that have an acquisition coming on at about cap rate about 7%, which is very good for mature properties. But again, getting back to that dividend, very strong yield, and the dividend over quarter after quarter after quarter for many years now continues to be increased, even if it's a small amount. And that basically reflects that rising cash flow.
Sure.
And over time, you have that great combination of that yield buildup and the underlying value of those assets, in which their book value, all those properties, all those leases, continues to build up year after year.
Real estate can sometimes get a bad sign hung around its neck.
Especially this year. I mean,
sure.
There are two things that hurt real estate and the REIT market in general. First, they both kind of happened at the beginning of the year. You had the fear over spiking U.S. interest rates, very ill-founded. We really instead have gotten sort of gradual rise to normalcy.
Right. Normalcy is a good word.
Which is a great word. The second thing is that people didn't read the Tax Cuts and Job Act of 2017. And they saw the corporate tax rate cut as saying that REITs that don't have to pay corporate taxes have less of an advantage than what they used to have. And therefore there was a sell-off there.
Okay.
And they didn't read that within the Tax Cuts and Job Act, you have the 20% deduction as an individual investor for your dividends. So REIT dividends, not only were they great to begin with,
right,
as far as not having to pay double taxes, corporate and then for the individual, but the individual gets to take 20% right off the top before they have to pay Uncle Sam.
See, back in the day, we would call that a tax-advantaged return.
Yes, indeed. And again, I think the REIT market really doesn't fully reflect that. WP Carey looks to it. I think in some of the other areas that I see a lot of value in is with cloud computing. You have a lot of these data center properties.
Okay.
And so, a couple of companies I've been focused on, Digital Realty Trust, you probably know DLR.
Sure.
And another one which is kind of moving their portfolio more towards this is called Corporate Office Trust, OFC.
That one I'm not familiar with, but tell us about it.
And OFC is very interesting because I came across this company in space largely due to its operations and its rapid expansion in the Northern Virginia area.
Okay.
Now, Northern Virginia, that's the home of the original AOL, which was at the epicenter of World Wide Web.
Sure.
So there's a lot of major trunk lines of the internet connection.
Makes a lot of sense.
Up there.
Sure.
So now you're getting a lot more of the data centers that are plugging into these hubs. You also have Dominion Energy that is developing some additional power sources that are fueling up these centers.
Okay.
So Office Property has a very interesting tenant in this area, in which they have 29 and expanding centers completely allocated to Amazon.
Amazon. I've heard that name.
Yes, and Amazon, as you know, is also looking for their headquarter too.
Right.
It certainly would make sense, as they're already looking at the Washington metropolitan area, that they seem to have a very good relationship with Virginia right now.
That would make a lot of sense since it's close to the power base in the country,
and many of their existing properties. But again, Office Properties has great collection of data centers, a good cap rate, and again, dividend yields, which is significantly higher than you're getting in the general market with the tax advantage.
And what's the symbol?
OFC.
OFC
for kind of loosely office.
There you go.
Kelley, thanks
My
very
friend,
much.
always good to see you. This is Mr. Neil George. I'm Kelley Wright at the Money Show in Dallas. Thanks.